Another one, so we call this quantitative tools. We will have the information, we'll collect the information. We can use this like a forecasting tools, or we call it the budgeting tools to make our prediction, to make our business plan. We have a big project, right? A big management, a landscape management simulation. Actually, simply speaking, this simulation is about the planning and then the controlling. The first phase is based upon the previous period, last year result, right? And then every quarter we make our plan, and then we will see the result, right? This is the simulation. And then actually we started to control. Planning, controlling, planning, controlling. This is a circle, a repeating circle. In the project, this is the very first, like a technique we need is called the forecasting. Trying to think about what is the forecasting tools. We call like a quantitative tools and techniques, but now we make it more specific. This is the forecasting. How we can, project the future sales, how we can project the future revenue, future expense, and then we predict what? The profit, right? This is immediately, you see, this is the income statement, or we call this a profit and loss statement, a balance sheet. So we predict, all right, forecasting our future sales, future revenue. But if we talk about the income, if we talk about the balance sheet, this becomes the budgeting, financial report, accounting documents. The next slide, I will show you some of very specific forecasting tools. Thinking about the first is the projection, okay? How we can, and then the second is how we can use the historical data, the time series. This forecasting is based upon previous data, right? And then how we can, receive this expert forecasting. Simply speaking, the projection is simply like just, estimate, give a guess, all right? And the time series forecasting is based upon the previous data. And then the Delphi forecasting is combined with, your prediction is combined with the expert opinion. This becomes the Delphi forecasting. Something more specific is about this forecasting tools, forecasting techniques. Let me just quickly go through this. Extrapolation is following the trend. Just assume, keep the same trend. Increase or decrease, same trend, same rate. Last year, increased 6%. This year will increase 6%. Next year will increase, 6%. This is just like a prediction, right? Very simple. Graphical analysis means, when we talk about the energy price, when we talk about this, the commodities, actually there are like the graphs show us the fluctuation, the price fluctuation. So in that sense, if this is, can you see the pattern? Whether this will go up further or go down from this diagram, we can see both are possible. The graph will help us to do a better job. Okay, so we use the so-called the graphical analysis. This is about the probability, right? So if we have our expert opinion combined with expert opinion, this become the Delphi forecasting. And then also don't forget to adjust for inflation, adjust for population. Those two are like minor points, right? For sure, if inflation high, we needed to add this inflation rate, particularly for sales. I remember about like 12 years ago, we have experienced a very high inflation. But when we defined the targets, big boss, they forgot that part. And then later on, it turned out, your target usually is on the nominal value. So actually that year we hit the target of three times bonus. So we needed to adjust inflation. For example, if your growth rate, you want to set the growth at the 5%, and then the inflation currently is about the 10%, right? So your target should be 5 plus 10, should be 15% instead of just 5%. If you set the 5%, very likely we don't need to do anything. Only by inflation, we have achieved the 10% growth. So the same thing is population is increasing or decreasing. So actually here, population is not accurate. We should talk about the customer segment. Your customer segment is growing or decreasing. First, you need to understand your segment. The second thing is you need to, analyze. We need to relate it back to this so-called environmental scanning, the market information. Okay, so moving average, this is very similar to the graphical analysis, right? So, but the moving average is more, you only see that the price change. Seasonality is clearly the pattern. Natural gas, it has a very clear pattern. Let me draw this for you. Winter, summer, go to the other hemisphere, right? Winter, and then summer, right? So you see, there will be the two peaks. We have winter, the other side of the earth, there will be the summer, right? But our summer will be their winter. The fertilizer producer, processor, they needed to take this into the consideration. So they needed to rely on the futures market to manage their risk. Not only this pattern, the seasonality, the complication beyond that is not only the seasonality, right? But also the inflation, okay? But also about the price fluctuation. And then you will see this is the pattern is like a up and down pattern. And then the inflation make it moving up, right? In addition, to that, there will be other factors, drive the fluctuation. This is our manager's responsibility to analyze that. All this put together, usually we talk about forecast what? Forecast the price, right? Forecast what? Forecast the sales, the turnover, right? Quantity times price. Our simulation project, actually this is the forecast, only forecast instead of forecast the quantity, and then we don't focus the price change. Actually, this is already very easy. If we focus the price change, this will be definitely very, very difficult. Other things like we will talk about some we call this linear programming, all right? So this is another, let's say, the mathematical way to predict, right? Try to find the optimized optimal combination of resource and activities. So for example, we have the, let's say that the labor capital, right? Raw material, how we can achieve the highest production, okay? By having those constraints. Okay, the very last one is about the break-even analysis. Our focus is based upon this break-even analysis. We needed to set up, or we needed to develop our target, right? To develop our strategy. Last year we are losing money, right? So although you can set like, oh, this year we needed to have like a profit of 5%, this is for sure okay. But usually we start with so-called one stage, you call it the break-even. Don't set your target too aggressive. Break-even is a good one. Break-even means that we can calculate our costs, our operational costs, our other expense, right? And then we assume like our, let's say, target is break-even, zero profit. This is the first step. Based upon that, all right, we estimate or we forecast our cost, right? Cost and expense, and then we assume our revenue is just cover the cost and the expense. We make a zero profit. Keep that in mind, that the break-even analysis could be our starter point, all right, for our project, for our simulation, management simulation project.